Hey, everybody. Good afternoon. This is Doc Severson with 12-Minute Trading. I'm joined here with Dave Lukas of 12-Minute Trading. Today is Monday, the 12th of February in 2024. And boy, do we got things moving and grooving today. We got all kinds of price movement. We have all kinds of risk this week, starting with a CPI tomorrow morning. We have retail sales later on in the week. We have the PPI, the Producer Price Index, wholesale inflation on Friday. And I think we are going to have more than likely a swivel chair day on Friday because it's a 3-day weekend into President's Day. So, Dave, what are you seeing out there in the markets?
Do my eyes doth deceive me? Do we have a red day in the markets? At least not the Russell. We'll talk about the Russell here in a minute, but the SPX and the NASDAQ actually have gone red into at least the last hour. And maybe that's a little bit of selling ahead of CPI tomorrow, taking some profits off the table would make sense. I'll say it. I said it last week. I've said the last 3 weeks that I thought the S&P had to tag 5,000, probably overshoot it before we could see any corrective action come in. And so we've done that now. We've got CPI on deck. We got PPI on deck. I think this market still runs up into NVDA earnings. That's right now. If you take out NVDA and you take Microsoft out of the market, out of like the S&P and everything, it's flat. So there's your gains. That's what everything's accounted for. And I think that we see NVDA run up into earnings, or at least stay about where it's at into earnings. And then after earnings is probably when you might see some profit taking on a move after earnings based on that. So those are kind of how I see the next week shaking out. I think we'll see some chop this week. The NVDA earnings will be very interesting. Guidance will be important. But the last few earnings are when markets have sold off and gone into a corrective mode. If you remember the run May through August of last year, that all culminated with NVDA's August earnings, where they blew it out of the park, and then all the selling started and took us into October. So that is kind of an interesting thing to watch, I think.
Yeah, we're all of 2.5 points down today. So it's turned into just a little bit of a doji day so far. Not much of a movement at all. And this is kind of what we expected. If we, let's go ahead and bring the charts up here. So we are seeing on the daily chart, we do have exhaustion down here, but when does it really matter? But what I think what's interesting though is, and we pointed this out, I think last week, that we were in a high energy environment here. And we did get the slingshot move from this. So it just keeps happening once again. So I would say support right now is, I don't think 5,000 is support until we get materially above that. So 4,900 is support. And then next thing is below there is a confluence of support with a swing test at 4,800 and the 50-day moving average, which is in red right there. So that's the S&P.
Yeah, I think the biggest thing on these charts is it's a very visible pattern now. Break out, go sideways, charge the energy back up, then go break out, go sideways, charge the energy back up, and break out. So I think the biggest thing we have to watch is that pattern to be violated. So we're into that point where we probably should see sideways action, some chop in a range for 3 to 5 days, right? That's about where we are if we are getting into exhausted energy. If we start seeing some selling and taking out those like down to 4,900 and stuff, that's going to violate that pattern. And so that's I think a key thing that we have to watch right now.
Hey, have you noticed the Russell 2000? So the Russell 2000 is going ballistic. I think they set the bear trap a couple of days ago down here. It looked like it was setting up for a lower high and coming down to a lower low at 1,900. And then it just pivoted right off of that 50-day. So I think the issue here is, can it get it materially above 2070? If so, we could be seeing a renaissance here of small caps.
Yeah, I think this is running up into CPI. You and I were talking about before this. Obviously, the NASDAQ has a lot of reaction to CPI just because of the high beta stocks that are in there. And there's a lot of debt that fuels a lot of tech. Small caps are the same way, right? Small caps, inflation hurts because a lot of them have, a lot of business loans and things and stuff that they need to take for growth. And so I think this is some run up into the CPI number. Obviously, it's pretty straightforward. If the CPI number is lower than expected or the print is lower than expected, markets probably continue to rally. If it's higher than expected, then you probably see some selling off, especially in the Russell. But this is the pattern the Russell's done. Look at that weekly chart. I mean, this is very, very much the pattern of this thing, the way it's been in this range for the better part of 2 years at this point. So I watched it get up there, where it's at now in the beginning of the year, and then it gave a bunch back and went sideways. So I think really the key to this whole thing is a good break above 2100. If it doesn't get above 2100, you continue to kind of stay in this pattern, this range. So I think that's just where we're at with this thing.
What I think is interesting here on the Russell is that for the first time, this is a legitimate higher low setting up.
Yeah.
So bounce off of here into higher high, legitimate higher low. So that is everything that you would normally want to see from a price perspective of a beginning of a reversal out of this. And the interesting thing also is from a chart perspective, this is a classic bear flag that everybody in the world saw, and then everybody on the planet saw it breaking down below the bear flag. And normally in a flag pattern, what you see is, and this is the problem, I have to make an aside here. The problem with chart patterns is now everybody knows chart patterns. 20 years ago, when I was studying chart patterns, nobody knew what the hell a chart pattern was. And now everybody does, and everybody talks about it, and everybody puts it into Reddit, subreddits and Twitter feeds now. Hey, look at this chart pattern. And then when everybody sees the same thing, the opposite will occur. So normally what we see with a flag pattern like this is that it forms a halfway house in the middle of the move. So the bears are obviously looking at this going, oh, we're going to go all the way down to 1,000. So they shorted mercilessly as soon as it broke down through here, and then right back in their face. So that is the sort of vicious nature of this market, is that when, it's constantly looking for the pain trade. The pain trade down here was going short, and all those guys got just knocked out. And we're seeing the same thing in every market right now. Those kind of things just don't go away.
Yeah, and it could be that the Russell is for once the laggard, right? And everything versus the leader, which is unusual, but it could be. I've been playing iron condors against the Russell for, since the beginning of the year because of that pattern you see right there. I've been selling basically outside of those things. And I've got, trades right now up in the high 2100s and the high 2200s, right? But if that thing breaks 2100, I'm getting rid of any top side because it can just run from there, and I'll just bring up the bottom sides and maybe even buy some calls on it, let it run. But there's another thing I think that's important to watch here with this week and next week too, Doc. I think we definitely need to look at the dollar and rates. They are creeping up, and the VIX is still kind of just hanging out, but it is up today, for a little bit. But we need a 17, 18, 20 VIX, I think, before I can even say that we have any change in polarity here. But you look at the dollar, you look at rates creeping up.
So here's the 10-year note, and I see 4.2%, which is over here. I see this as a third rail. If we touch this, if we start to close above there, I think the market's going to freak out, because
I do too.
We don't want to see, the market does not want to see a rising rate environment. And why would we see a rising rate environment, especially if we've gotten all these PPI and CPI numbers? And I think personally, it's because if you look at some of the other reports that we've got in, like jobs and just activity and everything else, the engine's still cranking away. The Fed has been unable to crush the market because of the animal spirits that are out there. And I think there may be other forces in play here, besides just the obvious, where the market does an amazing job of looking, like, for instance, looking past the election and looking at what the future might bring over the course of the next, 10 months from now or something like that. And maybe it's starting to price that in, that we're going to start to see increased activity. So the market.
Well, we're still printing money like drunken sailors. So I mean, that's
crazy.
That's a big piece of it. In fact, the Treasury, the market had a nice move when the Treasury came out, what was it, a week or two ago, and said, hey, we're not going to have to borrow as much for the quarter. But in the ensuing days since then, they've had, like, the amount that they said they were going to have to borrow, they're already like at the additional amount. Like, we're 30 billion a day type stuff, right? So it's BS. I think we're going to borrow a lot more than that. And then they'll come back at the end and say, oh, well, we had to borrow more, right?
Right.
That's kind of how this has been. The other things that are going on right now, guys, and like, I watch, Doc knows this, I'm really big on looking at the macro side of things and the trends and the underlying of things, right? So we've got more stocks moving under their 50 and 200-day moving averages. That's happening on a bigger scale right now. In fact, across the board, that's happening in even the tech and like S&P and everything. We have, like, speaking like of the leaders, like an NVDA. NVDA is now worth more than the entire Chinese stock market as a whole. Okay. Now, NVDA is a good company. It's got a bright future. I do believe that. I think it's going to continue to go. But NVDA is doing 20 billion a year in EBITDA. Okay. To put that in perspective, Apple's doing like 80 billion a year in EBITDA. Okay. So to say that NVDA is worth more than the entire Chinese stock market on 20 billion of EBITDA and a PE of 100, or so, this is what we saw in the .com times. This is different in the sense that NVDA does have earnings and revenue, which a lot of those stocks didn't. But Cisco was a bellwether back then, and I've seen some comparisons to the old Cisco chart, right? Which actually would put NVDA at 1,200 before it crashed, if you followed the Cisco chart from back then. But the point I'm saying is that you get this high concentration into just a few players, it goes parabolic, and then it does not end well. And I think we're closer to that than we are away from it, but still can have some room to go. So I think that's something to watch, though. But the valuations are getting pretty nosebleed and aren't justified by the fundamentals at all at this point. So it's all FOMO, it's all chasing. It's what you typically see at the end of a big move like this that ends up bringing it down. So, Doc, your thoughts?
Yeah, the thing I want to bring up, because I lived through the 90s and had some fun with at the 90s, and I was just trading stocks back then, and things were cheaper, so it was easier for you to just invest into stocks. But it was not that easy, though, to make money, because my round trip commissions, regardless of the size of the trade that I put on, was $30 through Charles Schwab. So for 100 shares, $30 round trip. So I had to like bake that into the gains. But fortunately, we had, crazy charts like this that were going on. So this is the Cisco move that you talked about, which I'm sure there were some split adjustments that handled in here, but basically this is what we're seeing. And so I guess the thing I want to point out to you, like, as you look at this Cisco chart, is just when you think like, wow, this is like really stupid, it gets more stupider.
Exactly.
It gets more stupider. And so you never know, like, what I think is impossible is finding out exactly where the top is. And this has been the biggest challenge I've ever had. And I've watched bear after bear after bear over the last 20 years just get run over and saying, wait, that's got to be the top. This makes no sense. And you can always tell when people are, voting with their wallet, because they get really, really pissed off when they get run over. And all of a sudden they're just pointing everywhere. Well, it's the Fed. It's they're printing money, and they're, and then next thing you know, it's like everybody else's fault but your own for making that decision. And that's
Well,
just the way it is.
yeah, Brewhead made a good comment too, and I forgot to mention this. I sent this out to the mastermind group too. The NVDA is worth more than the entire energy sector now. 147 billion in EBITDA. We're talking Exxon, Chevron, Halliburton, all those companies combined. Now NVDA is worth more than all of them, and it's doing 20 billion in EBITDA. So, like at some point, these things come back down to earth, but they can go for a long time before that happens. And if we talk about like the four phases of the market, and actually you could probably bring a chart up and illustrate this really well, but it's disgust, disbelief, acceptance, and euphoria. And so you have disgust at the kind of bottom of a move, and that would be like October, right? That was just absolute disgust, right? And then what started happening, if we just pull up like the SPX chart, what started happening is we started to rally in disbelief, right? And nobody believed that this thing was going to keep going, me included, to be honest. And then, but you got to recognize when you're in disbelief, and then you get acceptance, which is when things keep going, and then you kind of have that blow off top to finish it out in euphoria. And so, and these things happen on small scales, large scales, right? This can happen over the course of 10 years. It can happen over the course of a month. It can happen over the course of a week in a stock, right? So, but I think just right now, this seems like a weekly swing that's really playing out to that, those four phases of the market. And I think we're getting into the euphoria stage. So,
for you guys that want to learn how to trade price, there is nothing that you can do which is, I think, more effective than learning price action, because we all go through this. We become investors, and somebody somewhere along the way says, "Yeah, learn how to read price," and you're like, "Well, I don't know how to do that. That makes no sense." But I love those really cool looking indicators, and so we all go diving down the rabbit hole of indicators, and next thing you know, it's like years later, you become a jack of all indicators and a master of none. You've got all these lines all over your chart, but coming back to price is really where the thing is. I mean, if you go back to some of the live sessions that Dave and I did like a year ago, or even further back than that, we, not to say that we predicted the future, but we were here every day saying, hey, if the price gets above this level, then that's a change in polarity to a primary uptrend. So let me walk you guys through how you do something like that through what we call hard right edge. So let's see if I can do this appropriately here. I'll tell you what, we're going to have to walk it back a little bit more than this. We're going to have to go back like 10 years, and then I think we can. There we go. Okay. So here's the crux of the biscuit here. So we were in this kind of move, and this was into October of 2022. And so here's one of the biggest keys, I think, which is rule number 3 of fractal energy trading. Descending patterns will eventually break to the upside. Now, when the price breaks the upside, that is not a long signal, because you'll see, you could see something like this, the price breaks the up signal and then gets destroyed again. So that by itself is not a signal to go long, but what it is another piece of evidence. And so when Dave and I were back here going through this, we got to this point, and this was in late December of 2022. And you guys got to remember that this was around the time that the number one post around Twitter as it was known back then, was the correlation to the 2008 analog, which is predicting this. So everybody's buying into this, this sad face move here, like, oh, look out for this. And, the sentiment was actually horrible back then, because everybody was just cashing their chips in and just saying, well, here we go. We're going to go dumpster diving down below 3,400. This is going to be brutal. And then a funny thing happened. All of a sudden we got into January of 23. And what happened here? not only did we break the descending trend line, that was significant, but also we have a higher low and now a higher high in price. That's a change in polarity. There's two things happening here, that all of a sudden the price is starting to make an uptrend, whereas before it was in a downtrend. Now, the problem with cognitive bias with human beings is that nobody can see this. It's right in front of your face and you don't believe it. And this is due to your reticular activating system. This is due to your belief system. This is due to cognitive bias, because you have bought into the fact that the market's going to go lower, and it didn't do that. And so you don't buy it. You don't believe it. So you double down, or you blame it on something else. Oh, well, this is that damn this person or that person, or you blame it on Jim Cramer or something like that. So, and we got a second shot here because we got the bank crisis, and Dave and I were out in California having a meeting at that time. So we had our little bank crisis back then, and everybody's like, oh, that's it. This is just a bear flag. We're toast now. We're going to come, all these banks are going to go failing. It's going to be a replay of 2008. And the important thing is that it did not print a lower low. It printed another higher low. And then we got up to 4,200. And this is where Dave and I are going, hey, we got something going here, guys. If this breaks above 4,200, it's going. And this is what we said for weeks, is like, once we get above 4,200, we're gone. And we got a hell of a move off of there. We got all the way up to 4,600 before things went sideways. And then we get our little summer correction, but so that's
there's your interesting thing. I mean, you can look at the 4 phases of the market in what you just went through in that small little thing on a 6-month basically time frame.
Yeah,
that's what that was.
Dave was saying, here's disgust, and then here's disbelief. People don't believe it because they're locked into the downside at this point. And they don't want to believe it because they just got used to the downside. They just invested in programs that showed them how to short stocks and play to the downside. And now all of a sudden it's going higher again. And they're like, oh, wait a minute. No, I want it to go down again. And here we go. It's going down again. And so they went short down here, and then boom, right in your face. The market will always do the opposite of what everybody thinks it will. So I would say this is disbelief. Here's acceptance. So we got a very short euphoria from this one. The euphoria from this one is much, much stronger. We have a much stronger euphoria move from this one. So this to me is one of the fundamental things. If you can learn just the standard polarity of price action, it's going to make your life so much easier, because now you can think on both sides. Every day I'd come into the market and I'd say, I don't know what's going to happen today, but what will I do if the price goes higher? What will I do if the price goes lower? I don't know which way it's going to go. All I have to do is to be able to program myself and what I'm supposed to do.
Yeah, we were talking about this earlier too. Some people know this, but Doc and I funded an account at the beginning of the year that Doc and I are trading together. We brought our strategies together. We're trading it. We want to see, what a performance could be if we brought our different strategies together, short and long term. And we were just remarking, we're averaging, effectively a 3 to 4% compounded return by month. So we're tracking, probably 40% for the year right now. And relatively, I think we're only using 25% of the account or less right now that we're trading with. We haven't even ratcheted it up to 50% of the account, and we're doing that right now. And I think one of the things like he and I meet every week and we talk, okay, what state of the market are we in, right? Are we seeing higher highs and lower lows? Are we seeing, lower highs? Are we, so we're like, where are we in the market? Okay, what strategies need to be employed, right? Which ones do we need to back off of? Oh, we have risk events coming up, for this week. What strategies can stay on? What strategies should we clear just ahead and stuff? And it's been a lot of fun, but it gets us into really looking at it this way. And if you don't do something like that for yourself just your own business as a trader, like every Sunday sitting down, like what market am I in, right? What stage are we at? What comes next? What should I be prepared for? For example, the best time to buy defense is in times of peace, right? Well, we are, really going parabolic times of peace. What'd you do in your room today, Doc?
we set
What'd
up
you buy?
an out of the money bearish put spread, and I had to kind of explain. It's like what is that great line from Breaking Bad where Gus, you know who Gus is?
I don't know the line though.
The chicken man.
Yeah.
He meets up with Heisenberg and he goes, "Explain yourself," like that. And I think it's the greatest line ever. And so it was like, yeah, hey everybody, I want to put on a bearish put spread today. Explain yourself. Because nobody else is doing it right now. And this is kind of how you have to do things. It's like when you have the edge, it isn't necessarily the time when it feels like it's sane to do something like that.
Yeah, but for like 20 cents a contract, you can go out and put, or 50 cents a contract, go out, 45 days or so, buy some cheap put spreads that, could 10x, 5 or 10x on any move down, right? So like, otherwise it's a very small risk reward, but it's an asymmetric risk to reward if it pans out. And those are the things that you want to look for in the market. And so, if you're somebody who's following this and you're like, okay, we're into euphoria, we're starting to go parabolic. We've got stocks that are really highly concentrated, that are really, kind of the source of any more movement to the upside. And if one of those falters in any way, or gets like sold into like after earnings, like an NVDA, this whole thing comes back down to earth, right? And it's that kind of same thing. So, are you thinking, okay, I can, spend a couple $100 that could turn into $5,000, right? Right now to maybe take advantage and give myself a little asymmetric risk reward potential from any corrective action. And guys, a 5% correction from here is 4,800. That's not that's not much at all to get back to that level. So something to think about, as you start to learn this stuff and pattern it.
Hey guys, we just got a couple of minutes left. Is there any other questions or any other comments that anybody wants to make for today? So we did see your question out there, Brewhead. Is there a play into tomorrow? I think volatility plays into known events are very difficult. Like, so some of the folks that are been around this business for a while have looked into playing earnings, because earnings is a known volatility event, right? So that volatility is going to rise into the earning date, and then the day of it's going to collapse. And so people say, oh, you should sell iron condors. But the problem is that a lot of times the move will go way beyond the expected move and run you over, and there's a negative event. So you give back a lot, you take a little sometimes, and it's like overall, it's not really a great thing to do. So a lot of times we just sort of sit on the sideline for risk events. To me, it feels a lot more like gambling. There's a big difference between gambling and the type of statistical based investing that we do based on the theoretical edge of time decay, right? You just can't get away from that. It's like time passing. The sun's going to come up tomorrow. Time decay will occur of any option that we sell.
Yeah, it's hard, and it's hard to play the volatility events like this because always think about like a balloon blowing up with air, right? Like you're swelling into the event, and then the event happens, and it's like whoosh, all the air comes out. That's what happens like in the options chains. So there's a lot of times where you can have you can get yourself into an options position, and it literally, even if it goes your way, can be worth less than what you got into it for after the event happens because of that collapse too. And you don't make anything. It's hard.
There's one more thing that makes things really difficult. And it's, I'll tell you what, one of the things, quite honestly, I do not trade the VIX because I don't specialize in it. If you want to trade the VIX or a volatility instrument, you've got to specialize it. There's people that are in my live trading room that's all that they do. I'm You know, like I don't really even speak to it because it's like you have to have a level of experience. The problem is term structure. So you've got to understand backwardation. You got to understand contango, the term structure. So the VIX options or, you know, the volatility options for next week may be really, really different from ones a month out or 6 months out. So a good example of this might be like, oh, I want to hedge against an event over the next 6 months. I'm convinced that within the next 6 months, we're going to have some kind of a downside event. Problem is that when that event comes, those VIX options that are 6 months out may not even budge. They may not move at all. And that's the term structure because the market's so smart there. They go, it's going to be just a bounce. We don't need to move those options at all. And so not only do you have to get the timing right, but you have to get the structure right in terms of the amount of time. So
the one thing that I will do, I'll do earnings. I don't do anything around VIX or CPI type events, but I'll do earnings on the high flyers. So like NVDA earnings, you know, I would look at, and what I typically do is I'll go to the next option cycle. And this is total gambling. This is like just, hey, I'm going to have some fun, see if I get lucky, but I'll buy like a 5 or a 10 wide spread on both sides for the same price. So I typically try to keep it like $1 to $1.50 is what I pay on each side, you know, for the contracts. And I buy the same amount of contracts on each side. One side typically will win. And I'm going out, I'm maybe going out 15 points away from where the money is. And I'm doing it right before close, right before earnings. So like, you know, 3:56 p.m. on the day of earnings before close, I'll buy that, right? And then it'll, based on the move, you know, I'll make up my loss on the one side with the other side if you get those high flyers. Now, you used to be able to do that on stocks like Apple and stuff. You can't do it on Apple. Apple like can sometimes barely move on earnings. I did it on Meta just recently, and I crushed it. I made a lot of money on my Meta call spreads, right, for that. Netflix has been one that's been pretty good. NVDA is one that I think we can see that. But again, you can have these times where they just don't go anywhere around earnings. Like Microsoft didn't go anywhere on earnings. Google didn't really go anywhere on earnings. And so you lose on those trades, but it's a total gamble. So that's just an example of something that, you know, I found that can work once in a while. When you hit it, it's a lot of fun, but you know, most of the time you're probably going to lose it. So,
yeah. Okay, guys, we're out of time, so we don't want to take any more of your time. We want to thank you for joining us here. So whether you're live or whether you're watching this on a replay, we appreciate any activity. Tell your friends, tell your families, get everybody involved and get them educated for this next move. All right, everybody, you guys,
awesome, guys.
Take care. And from Dave and myself here at 12 Minute Trading, wish you adieu. And we will see you guys in the next one. Adios.